Hi there and welcome. My name is Bronson. I'm the Director of Investor Relations at Nighthawk Equity, and I'm here today with the one and only Michael Blanc. Welcome, Michael.
It's great to be here, Bronson. What are we talking about today? I can't wait.
Great. Well, we have another exciting topic here today. We're talking about forced appreciation versus market appreciation, which are two totally separate things. And so sometimes it comes up on our calls with investors is just what does this look like? So can you explain maybe the difference between the two?
Yeah, forced appreciation is, well, let's start with market appreciation. Market appreciation is what most people are familiar with, right? The market goes up, the market goes down. We saw that, in the Great Recession, the market went down and everybody was scared and screaming and yelling like little girls. And so, that the market is basically when some things is driven by comparables. So sales comparable, something sells over here, it now dictates what my value is worth. If my rent is this, my rent's that, then my rent's going to be similar. So these are market forces, market-driven things. The forced appreciation is something where I can essentially force up or down the value of an apartment building, right? So as most of you guys know, the value of an apartment building is driven by the income it produces. So I can have a box that's worth $1 million and a box just like it next to it is worth $1.5 million. And the only difference is the one for $1 million is producing less income than the same identical box, same number of units as the one next door. So I could buy that $1 million box. I can make it produce the amount of income that the one next door, and now that box will be worth $1.5 million. And that's our favorite. That's called a value add strategy. The value add strategy uses a forced appreciation model essentially to make it appreciate more regardless of what the market does. So if the market were completely flat during this time, the value of the building would go up. If the market were to go up in this time, it would go up even more. If the market were to go down in that time, then it would not go up as much as if the market were steady, right? But essentially, I am controlling the value of the building, and that's what's called forced appreciation.
Thanks for sharing that. So when we have these two types of appreciation, which would you say is more predictable?
Well, typically the forced one, for sure. The problem with the market is I need a crystal ball to forecast that. And, we try to play the game. We try to forecast, where are demographics moving. We know they're moving from colder climates to warmer climates. We study migration patterns. We discover, we look at cities. What is their economic forecast? How many jobs are creating? How many jobs are inclined to or going to? So we try to predict the market. And it's an important thing. You can't just blindly go into a market because you want to, rising tide lifts all boats. So you're looking for markets that are improving. The ideal combination, Bronson, is you're finding a market that's improving, and then you're forcing appreciation in that market. You really want to do both. But obviously, the more predictable is the forced appreciation. What I mean by that is I can create a business plan that takes 18 to 24 months to execute. If I execute on that plan, it's going to have very predictable results. So, for example, if I put $5,000 in per unit, I can get a $100 rent bump. And I know the $100 rent bump because the two buildings next to me are getting the same rents, but they look a little nicer. And in order for me to make my box look like that box, I'm going to have to put some money into it and make it look like that. And presumably if I do that, then the rents are going to be about the same as the other ones. So it's a very predictable thing, and it's with surprising accuracy. And like I said, if the market continues to go up in unpredictable ways, then it will enhance that business plan. If the market doesn't quite cooperate, I might not be able to get a $100 rent, but maybe I can get 75. So I can still force the appreciation according to my business plan. But the point is, a good business plan should articulate the problem with a property very clearly. It should be easy to understand what the problem is. Oh, the renovations the units don't look as nice as the one next door. Therefore, the rents are lower. Okay. If I can understand that, then the business plan to execute on that is something that the investor can understand. If someone is promoting a business plan that doesn't make a lot of sense, you should ask questions and be a bit suspicious about the ability to essentially force the appreciation of that asset.
And this is why I like forced appreciation, like value add deals, because you can come in and see, like you said, the market down the street, the rents down the street are significantly higher. If you just do these increases, it's very predictable how you're going to get there, which is great. So when we look at the other side of that with market appreciation, can you talk about what affects market appreciation, whether market appreciates a lot or it doesn't appreciate?
Various factors. I think we had another video on this just not too long ago when we're talking about, what are the macroeconomic forces, let's say for a city. Okay. So demographics, baby boomers are moving into warmer climates. What are they moving out from? Okay. Well, colder climates. Okay. So that will affect the market, versus if you're a recipient of that, you have more people moving into a market that's going to slowly drive up drive up rents, and it will keep the vacancies as low as possible. So those are some of the market issue the factors that you want to look into, to try to essentially predict where the market is going.
So when we're looking at this value add strategy with the kind of the deals we do or a general that are done, you have both forced appreciation and market appreciation. So how does conservative underwriting kind of fit into that when you're projecting all of this?
Okay, yeah, that's a great question. So we want to be conservative in our underwriting. So as a passive investor, when you're looking at deals, whenever you're evaluating investment, you want to see how they're underwriting, and underwriting is a fancy word for what assumptions are they making. Are those assumptions, do they seem reasonable given what you're being told? Do they maybe appear aggressive? So for example, with regards to market, there's something called a cap rate. A cap rate is essentially a multiplier. We talked about an apartment building is worth more the more income it produces. Well, how much how much more does that produce? And this cap rate is essentially this multiplier. So that multiplier determines how much more something is worth based on its income. So that cap rate varies from market to market, right? That cap rate you can get from brokers or from appraisers. It's a fairly well understood thing that is determined by comparable sales. So let's say I'm buying something at a cap rate of 6.5%. Okay, it's just, without getting into, I don't want to get into a rat hole of what the cap rate is. It's just a multiplier of way to value it. Essentially, the lower the cap rate is an inverse relationship. The lower the cap rate is, the more something is worth. Okay, and the higher the cap rate, the less something is worth. So it's an inverse relationship. But if I'm buying something at a 6.5 cap, and I'm projecting in the future that the cap rate will be lower, that is unlikely to happen because the cap rate is so low primarily because of the low interest rates. So interest rates are, I suppose it could go lower. You know, Trump is talking about going to negative interest territory. So what do I know, right? Could go even lower. But it's difficult to predict. It's difficult to argue that in the 5 years from now, the cap rate's going to be even lower. It's possible, but it's not very conservative. So for example, when we're predicting the sales prices of our units, we're always assuming a higher cap rate, which means that we're assuming in 5 years, because cap rates are higher, we're assuming that real estate will be valued at a lower price. Okay, so it's conservative. So that's an example of where a market predictor is conservative versus aggressive. On the forced appreciation, it's all about net operating income. So what am I assuming around income? How conservative am I being with my projections? You know, if I'm projecting expenses of 38% of income, that's really aggressive. Typically, we see expenses between 50 and 55%, right? So if you're seeing projections with a low expense ratio, you're like, that seems a bit aggressive. If someone is predicting, you know, $150 per year rent bump in year one, that's really aggressive, right? How are you going to do that? I mean, you're going to have to turn people over. There's going to be increased vacancies. People are going to move out when you take over. So that doesn't seem very likely. So in other words, what is the prediction on rental income? How realistic is that? How aggressive is that? How conservative is that? And then obviously the difference between income and expenses is the net operating income. So in other words, just really look at the assumptions that an operator is using and ask yourself the question, how believable is that? And also how conservative is that? In other words, how much margin for error is built in? When we're predicting that, you know, cap rate is going to be higher in 5 years, we have a margin of error built in there. If it stays exactly the same, we're going to do better, right? If for some reason we go into negative interest rate territory, wow, we're going to be doing awesome. But let's say interest rates do start going up, then our business plan is still going to be on track because we build in that margin for error.
Thanks for sharing that, Michael. I think that's a great idea of, you know, a conservative underwriting when it comes to these factors. So I want to say thank you to our audience for joining today. Again, we love doing these videos. We love sharing this information with you. So there's two kind of things you can do. If you're just kind of new to this and you're kind of feeling it out and saying, I'm not sure if this is for me, but I want to learn more, then check out this report that Michael put together. It's very compelling. It puts together, kind of compares to the stock market, to apartment investing through syndications. It's available at the michaelblanc.com/report. And it's a free report. Take a look at that. If you're saying, hey, I've been a part of this, or I'm really interested in kind of hearing about deals, I want to join your club, we have something called the Nighthawk Investment Club. You can go to nighthawkequity.com/join, and you basically set up a call with us. We'll establish a relationship with you, and we can see if it would make sense to work together to do future deals. So thanks again for taking the time to educate yourself, and we will see you on the next video.
Hey, don't go without grabbing that free report. That's right here and subscribe to our YouTube channel because we put out videos like this every week. You don't want to miss it. And check out this other passive investing video.